Some new analysis out from international consultancy Wood Mackenzie about how the energy transition uncertainty will affect the upstream oil and gas industry. And, if you follow our interviews regularly, you know that energy media's take on this is that we're about 20 or 30 years into the current energy transition, and the 2020s are the disruptive decade. Uncertainty is going to be the hallmark of the next decade or so. And how that'll affect the oil and gas industry, our access to energy, is an open question. I'm going to talk to Fraser McKay, who's the head of upstream analysis for Wood Mackenzie, about this. He joins us from the UK. So welcome to the interview, Fraser.
Thank you very much for having me today.
Now, this is really a hot topic in the oil and gas industry specifically, because how the energy transition, the pace at which it proceeds, and the structural change that it engenders has a lot to do with how companies get access to capital, climate policies that their governments impose, those sorts of things. What's your take on how uncertainty will affect the upstream oil and gas companies?
Thanks for that, Ed. I think ultimately that's fundamental to how oil and gas companies will navigate the upcoming decades. We recently wrote a piece called Swimming Upstream, which focused on just this topic of uncertainty and how companies deal with that. And the sort of precept for it was that for about 100 years, we've been used to oil demand in particular that has grown by around 1 million to 1.5 million barrels a day, on average about 1 million barrels a day for 100 years. And suddenly we're faced with the situation where we don't know if it's going to grow by 1 million barrels a day. And most likely it's going to either plateau or perhaps even decline. And that decline rate, the pace of that transition that you mentioned, is critical to how companies can position themselves and appropriately invest for that future scenario. So the range of outcomes for oil and gas from a demand perspective has probably never been greater. And that impacts everything that they do and how they allocate capital.
Fraser, in Wood Mac's most recent press release, you noted that despite record cash flow, and the 2020s are going to be very, very profitable for most oil and gas companies, but you noted that for many stakeholders and even some CEOs, the sector's risks outweigh the upsides. Could you explain that, please?
Sure. Thanks for the question. So I guess when we look at the oil and gas industry, the reset that's taken place over the last two downturns have positioned it very, very well for capturing any price upside. So when we look at where we are at prices that we have in the $80 per barrel range, because of the reduction in overheads and costs that the industry has, that would result in record cash flows. Now, I wouldn't predict that that could happen for a decade. There's always something that happens. That range of uncertainty that we talked about will create volatility. So we're not sort of predicting a lifetime of record cash flows for these companies, but that potential exists. And when we talk about the appetite for risk in that situation, obviously, it may not turn out like that. And obviously the pace of energy transition introduces, as you said, risks to long dated projects. The $130 trillion that has been earmarked for investment in clean energy and looking at a policy of reducing investment in upstream oil and gas raises the specter of increased lending costs and a reduced pool of backers for that. And obviously, we've seen moves from very large companies such as BP, such as Shell, such as Repsol and others, to make clear and firm statements about what they view their upstream businesses are, which is cash cows to feed investment into new energies and become energy companies rather than oil and gas entities. So whether it's backers and stakeholders, or whether it's governments considering their own role in what the energy transition looks like, there's clearly a much larger uncertainty in terms of what an upstream business model looks like. So whilst that sort of record cash flow might exist in the near term at least, how that's allocated then in the future might be very different to how it's been in the past.
There's been a lot of concern over the last little while within the industry about access to capital and cost of capital. You alluded to that in your last answer. And in your release, you say, watch for the pool of backers to shrink, borrowing cost to increase, and project financing for oil to get harder. So what role does the perception of risk by lenders and investors affect that borrowing costs and access to capital?
Yeah, absolutely it does. And it's obviously the risk from a demand perspective, but also the other risks of the other ESG factors for companies and projects. The longevity, the timeline for projects is obviously an issue as well. It's much harder to predict what the future for oil and gas is 10 or 20 years from now. So projects that have a long production profile or a long payback period are inherently harder to both, make a project sanction decision on, but harder to finance also. So what it comes down to is having the most advantaged barrels in your portfolio, focusing on projects with the lowest Scope 1 and Scope 2 emissions, and ideally the shortest payback possible, or perhaps where it's gas projects, looking at the combination of CCS and gas, where it is long-dated gas projects to offset maybe the impacts of being compared against fuel switching and other things. So it sort of changes the goalpost, but doesn't ultimately fully restrict funding, because whilst demand still exists and while projects are still possible and still profitable, then there will still be entities who will back upstream oil and gas. But clearly, as that pool of potential lenders by either regulation or by risk appetite shrinks, then ultimately that drives increased cost of financing projects and companies.
Fraser, have you got any insights into which countries, which sectors will be affected more or less? And I'm thinking maybe, onshore producers in the US, like the Permian Basin, maybe Alberta's oil sands producers, offshore, the Saudis, and so on. Everybody's going to be jockeying for a smaller piece of the pie here eventually. What's your take on how those various countries and sectors and companies are handling risk?
That's the multi-trillion-dollar question, really. But the true answer is it ultimately, again, depends on the pace of that transition, because if, as in our view, we see liquids demand peaking in the mid-2030s, but the declines thereafter are just in low single digits, then there's opportunities for all of those companies to develop their most economic barrels and those that are at the lower end of Scope 1 and Scope 2 emissions intensity. If, however, there's a more accelerated transition scenario and the declines are in the higher single digits, then clearly you're going to see some countries and companies where they're just priced out of the market. So the lowest cost suppliers, Russia, the Middle Eastern resource holding NOCs, are obviously in the advantage position from when it comes to a supply perspective, but there are obvious impacts if prices also follow that demand down. So again, it depends on the pace of the transition, what happens to all of the companies as they transition. If prices are indeed as low as you might expect them to be, then it's not actually a particularly rosy scenario even for those resource holders. But what you can assume is that anything above a sort of minimum level of price, a sort of economic limit for prices to our base case scenario, is that there are opportunities for continued economic oil and gas extraction from all of the countries that you just mentioned.
Is it fair to say, Fraser, and we'll wrap up our conversation with this question, that in 2018, I interviewed your colleague, economist Ed Raleigh, about a peak oil demand study that Wood Mackenzie did. And he made the point that then they expected peak oil demand around 2036. Now we see the IEA saying maybe late 2020s, early 2030s. So it's going to be, looks like it's going to arrive a little bit sooner. But Ed made the point that it's the decline curve after the peak that really matters. Everybody wants to, is looking at that and trying to figure out what that will look like. And that I guess is what you're saying is how fast and how disruptive will the energy transition be? That will then have its effect on that decline curve, and then that has ripple effects into the industry about who will survive and who won't.
That's absolutely right. Yeah, Ed wasn't wrong. But basically, if you think about it, the natural decline curve for oil and gas, depending on your assumptions of what happens with countries and projects, could be anything between 5 and 10%. And if you go out a few years and you have maybe a peak in the, we're still forecasting sort of in the mid 2030s, but even if you assume it's earlier, if that only declines at 2% or 3% thereafter, you've already got quite a large discrepancy between zero investment case and your accelerated energy transition case. So there's still a large amount of capital required to be spent on the industry just to replace that natural depletion that happens at oil and gas assets. So the investment opportunities and the economics could still be in place for a large proportion of the industry, but it isn't crucially dependent on how quickly that declines. Because we're in a depleting business, we still need to invest almost regardless of the situation. There is no feasible zero investment case. There is no feasible transition scenario that gets you that fast out of oil and gas. So there's still an investment scenario. How much investment is entirely dictated by that ultimate decline in demand and the period of time over which that occurs.
Fraser, thank you very much for your insights. Really appreciate it.
You're most welcome. Thanks for having me.